Hi, good morning, everyone. I'm doing- Hi, good morning, everyone. We are waiting for a few more joiners, and we'll start webinar within few minutes. That is great. More and more people are joining. Fine. I think it's a right time to start. Just wait for the few seconds more because we don't want people to not miss anything. But I will take care of the sound. Thanks for this. Rakesh, can you hear me, please? Okay, great. Great. Perfect. Now we are up to the mark. I think let's start with that. So let me introduce myself. Myself Bineet Shah. I am from the Crow UAE and managing tax and technology. So as you know that tax without technology, tax is difficult to manage. So I am manage both the things. As everyone is aware about that new corporate tax has been launched and started from this month. So obviously that everybody is keen to know about that, and especially people those who are outside UAE. So the purpose of the webinar is to make aware about the complete compliance about the UAE tax law. So obviously corporate tax is also going with the transfer pricing also. It might be applicable for the clients, those who have a presence outside UAE, maybe headquarter in some other countries, and having a branch in UAE, having a headquarter in UAE, and having a branch in outside UAE. So all these things is going to be applicable, and especially that now the about the certain things about the housekeeping. So on your right side, there is a chat box for any questions, and with regarding to webinar, you can put there, and we will try to answer and attend your questions in those cases. This after the webinar, we are going to this link, send you the link of the webinar, so you can review or you can share with your other colleagues about this. So today's the prominent speakers are that is Rakesh Nair. He is from the he's the director in the Pro UAE for the direct tax. Then another is Mr. Valentin, managing partner from Pro Valentina, Italy. Then Mr. Smardev, he's from the Pro Mykolaiv, Ukraine. So we try to gather all the team members from the Europe, Ukraine, and UAE to assist you well. Uh, our prominent guest basically is from the LTC group, Mr. Rana. We are heartily thankful to him to join this webinar and give his input as a client, what they are going to face any challenge and how they are going to mitigate the corporate tax. So over to Rakesh for your floor is to you, Rakesh. Thank
Uh,
you.
Thank you for the kind introduction, Mr. Vinith. Good morning and good afternoon to the participants. So, as you would be aware, the new corporate tax law has been effective from 1st June 2023. The corporate tax law has provided various deductions, they have provided various relief, various exemptions, and certain exemptions, reliefs, and deductions are subject to conditions. So our first topic is on the taxability of free zones. This was a much awaited topic. Most of the free zone entities wanted clarification whether their profits would be taxable at 0% or whether they would be paying tax at 9%. The law is pretty clear. Comply with all the conditions and take the exemptions. If you're not complying with any of the conditions, pay 9%. So the first and foremost condition is you have to have a adequate substance in the free zone. So adequate substance has been clarified in the decision. That is, the free zone has to undertake core income generating operation. Fair enough. For any entity, they have to do their core business. They have to earn income by doing the business for which they have been incorporated. Secondly, they have to have adequate assets for performing those core income generating activity. They need to have a qualified employees for conducting those activities, and they have to incur certain operating expenditure, adequate operating expenditure for earning the income. So basically, they have a linkage with the prevalent economic substance regulations. They have picked all these from the ESR. So most of the entities would be compliant with the first conditions. The second condition is you have to comply with the transfer pricing provision. If you have a intercompany transactions, ensure that it's at arm's length, maintain all the documentation or associated compliances which needs to be done if a transfer pricing is applicable in your case. Third, and the most important point is which could be a decision maker whether you want to be in a free zone entity or whether you want to opt out of a free zone entity is that if you are in a free zone entity, you have to mandatorily get your financial statements audited. There is no threshold, unlike a mainland entity where there is a threshold prescribed by the law, which is AED 50 million. The fourth condition is you should not have opted the free zone entity should not opt for the 9% tax rate. So when does this come into picture? Let's take an example. A overseas entity has a subsidiary in the free zone entity. And as per the law of the parent entity, if the subsidiary does not pay any tax in the source jurisdiction, that profit will be taxable in the parent jurisdiction at the rate in force in that jurisdiction. Suppose if the parent company jurisdiction has a rate higher than 9%, it is always preferable to pay tax in the free zone, so that they doesn't suffer higher rate in the parent company jurisdiction. The fifth and the most important condition is deriving a qualifying income. So this has been recently clarified by the uh, authorities. What is qualifying income? If a free zone entity is dealing with another free zone entity, and if they are deriving income from activities which are not excluded activity, it will be treated as a qualifying income. If a free zone entity is dealing with a non-free zone entity, a non-free zone entity could be a mainland entity or a foreign entity, and if they are deriving income in respect of qualifying activity that are not excluded activity, it will be treated as a qualifying income. The law has provided that if you are receiving, if the free zone entity is receiving any other income, it has to satisfy a de minimis requirement. That is, a non-qualifying revenue can be earned, but it should not exceed 5% of the total revenue, or a threshold of AD 5 million, whichever is lower. So so basically, to sum up, if you are earning a qualifying income and you are satisfying all the other conditions which is prescribed under the law, you can claim a 0% tax rate. And for qualifying income, for determining qualifying income or a non-qualifying revenue, a certain revenue has been excluded from the calculation. That is, if the free zone entity has a P or a branch in a mainland entity or has a branch in a foreign country, then the income from those branch or a P will be straight away taxed at 9%. It will not be included in the calculation of qualifying income, neither the non-qualifying revenue. So it will be directly taxed separately at 9%. So what is qualifying activity? What is excluded activity? We can take up in the later part whenever we have a Q&A session. So moving on to the next important topic of international taxation, permanent establishment. So what is a P? What is the significance of a P? Suppose a overseas entity can either have a subsidiary in the UAE, they can perform the activities in the UAE, and the subsidiary will be paying taxes on the profit generated in the UAE. Alternatively, what a overseas entity can do, they can have a non-juridical presence in the UAE, that is in the form of branch office or branch or a office, wherein they will either pay a less tax or they will pay no tax in the UAE. So the role of P comes into play when you have a non-juridical presence in the UAE. So P determines whether the business profit of a non-resident would be taxable in the source state. So before moving on to the implications of the PE, let's see which all PE has been covered under the UAE corporate tax law. So these are the types of P which have been covered under the UAE corporate tax law. First is the fixed place P, that is a fixed place of business from which the business of the non-resident is wholly or partly conducted. So it has to be an income generating activity which needs to be undertaken from a fixed place. If there is a preparatory or auxiliary activities, if if the subsidiary is only performing or the branch is only performing a preparatory or the auxiliary services in the UAE, then it won't constitute, the non-resident won't constitute a PE in the UAE. So it is very imperative, if a non-resident having a presence in the UAE is earning any profits from the UAE, to evaluate whether there is a PE exposure or not. The second P type of P which has been covered in the corporate tax law is agency P. If the agent, be it a related party or a unrelated party, is providing any kind of marketing support services, it is very imperative to analyze whether there is an exposure of agency P. An agent can either conclude the contract habitually, or they can secure the contract which is habitually concluded at overseas level without any material modification. In such cases, very imperative to have the analysis of P and take appropriate precaution in the form of housekeeping measures. Third form of P which has been covered is if the overseas entity has an excess in state, we are still awaiting clarification on this. So all in all, if any of the overseas entity is performing any kind of business operation and earning business profit from the UAE, have do a proper analysis of P exposure, have proper housekeeping measure in place to avoid P. What if there is a P in the UAE? There will be a attribution of profit to the P. The P would be subject to corporate tax on the income attributable. They will have to obtain the registration. They will have to maintain the documentation. If there is any transaction between the P and the overseas entity, they will have to comply with the transfer pricing provision. So it's not about paying 9%, it's all about the associated compliances. So better to have a proper evaluation of P and take adequate housekeeping measures in place. The next topic is on the key consideration. Until now, there was no corporate tax in the UAE. Now, with the corporate tax coming into force, it will have a key impact on all the mergers and acquisitions. Have a due diligence done. Typically, due diligence is done on the past records, past compliances. Considering that this is a new law in place, you can have, if a acquirer is trying to acquire, is planning to acquire a UAE target, they can have a pro forma due diligence. A pro forma due diligence could cover whether the free zone entity would be eligible for a potential 0% tax rate, whether they would be able to comply with all the conditions. In case of intra-group services, whether the transactions are happening at arm's length price, and other TP considerations are being added to. Foreign tax considerations, like whether the overseas entity is creating a P in the UAE, or the deeming residency conditions, like if the acquirer is acquiring a UAE target and the UAE target has a subsidiary overseas, and if the overseas subsidiary is being managed and controlled from the UAE, the overseas subsidiary will be treated as a resident, and they will have to have all the compliances in place. They will be treated as a resident company, and they will have to pay tax on their global income. So with this pro forma due diligence, you can actually get a hold of such exposures. And once you have the due diligence in place, this will impact your indemnity clause. You can increase your indemnity or change your valuation of the deal accordingly. Second is structuring, whether to have an intermediate holding company such that there would be a proper repatriation of profit from the UAE uh, to outside the UAE, or whether we can have savings on the uh, on tax while we exit from the structure. So this, whether to have a funding, like until now, the even if you're investing through equity or debt won't make any difference. Whether a leveraged acquisition should be done, taking into consideration the new law, whether if I invest through a debt, whether the subsidiary company or the target company would be able to claim deduction of the debt, needs to be analyzed. And there has to be proper documentation with increasingly, a tax review of share purchase or asset purchase agreement will find more importance on analysis of the deal documentation. key areas would be tax indemnity, period of coverage given the statute of limitation under the UACT law, de minimis and tax indemnity caps needs to have a more detailed consideration than the earlier on while dealing with the UA targets. Even on the insurance coverage on deals may need to include tax within the discussion with representation and warranties. All in all, tax will have a major impact on all mergers and acquisitions. Thank you. With this, I hand over the floor to the next speaker, Page George.
Uh, thank you very much, and hello everybody. It is really a pleasure being here today with you. And let me start by mentioning geopolitics and tax in a very brief manner. In the last few years, we assisted to a reshaping of the value chains worldwide, and this is a trend that will continue. So the international tax framework has changed quite significantly in the past years, and it will bring additional challenges to businesses worldwide. This requires a close monitoring. The preamble to the OECD model rules states that the underlying policy intent is to provide for a coordinated system of taxation intended to ensure large multinationals pay a minimum level of tax on the income arising in each of the jurisdictions where they operate. It does so by imposing a top-up tax on profits arising in a jurisdiction whenever the effective tax rate determined on a jurisdictional base and if this is below the minimum rate. So within the major developments which impact businesses worldwide, this is the famous two-pillar solution to address the tax challenges also arising from the digitalization of the economy. There are three fundamental areas to be considered. The first is the coherence in the international tax rules related to cross-border activities, strengthening the substance requirement in the international standards, and global improvement of transparency. This new orientation seeks to minimize or eliminate non-taxation to facilitate the better alignment of the taxation of multinationals with their economic activities and value creation, and to improve the information available to tax authorities so they can implement tax laws effectively. But what about strategic tax? Tax plays a crucial role in making supply chains more robust and less challengeable for the years to come. And also the international tax framework has changed, and tax needs to be in the boardroom, and transfer pricing is a matter that will keep us busy in the next months and years, I'm sure. But at the same time, all these might result in local and international tax controversies. What about the UEA? Well, we assisted in the recent years, we assisted to the introduction of VAT, the introduction of substance-based rules. The new rules also bring further developments in the field of transfer pricing. And now we see the introduction of corporate income tax. These are top matters for boards and C-suites to take into account. So I would like to highlight tax, accounting, and legal functions should work in coordination, carefully monitoring the implementation of new rules and the release of new guidance. An assessment of the impact of the new provisions for the company and the overall group should be done. Companies should review systems and implementation of the new provision within their organization, also review legal structure and the business model, the value chain. And also every company should plan and ensure adequate resources and capabilities within the finance functions. Depending whether the companies are located in the mainland or in the free zones in the UAE, the board should check on the implication of the new rules, check the substance requirement, assess transfer pricing implication for the company, as well as the intercompany transaction in place, and the value chain analysis should be carried out. Now, I would like to bring to your attention some of the key points a big company, Legnano Tecnoelectric LTC, which is a third-generation Italian family, is working on. The group is a long-lasting Acrovalente client, is headquartered in Italy and with the operations in several countries, as well as in the UAE and Dubai. So, Rana, the floor is all yours. Please.
Thank you very much, Mr. Piergiorgio, for allowing this opportunity to represent our company to the audience of this webinar. I represent Legnano Tecnoelectric Company, Middle East FZCO. It's a subsidiary of LTC Group based in Italy. And basically, we are operating in the transformer sector for over 65 years, while our company in Dubai was established in 2009, when our management decided to have presence even in UAE local market as well in 2009. Basically, LTC Group is owned by the Bertelli family, and they have based this group on solid experience in the design and in the production of electrical transformers for the local market initially. But nowadays, LTC Group has a global presence, and thanks to many facilities in Italy and in Dubai. Recently, we have also acquired a new production facility in Taiwan to capture the Asian Pacific region. And we also have plans for further growth in our pipeline. Concerning the UAE corporate tax, I will just give a brief overview of our approach to the implementation phase. For the time being, we are still developing our knowledge and understanding of the UAE corporate tax by exerting reasonable efforts in obtaining the in-depth assessment analysis and the analysis of the implications of UAE corporate tax on our company, as well as our transactions with our parent company. And our parent company, which is based in Italy, they already use Croway as their consultant, and we are sure that we can also find some reliable consultant here, even in Dubai as well. Well, although UAE corporate tax has been in effect since 1st of June this year, but since our year runs from January to December, it will be applicable to our company from 1st of January next year. And this has allowed us ample of time to plan the implementation strategy and to implement the UAE regulations after the in-depth assessment has been carried out, so that we make the well-informed implementation in our company. As far as our current understanding is concerned, we understand that there are few regulations, there are few tax reliefs available to free zone companies, provided they meet certain conditions. And we are currently looking into the details of such kind of reliefs available to our company. And since the corporate tax is still developing, and there are some more tax matters to be clarified from the government of UAE, we are trying to keep ourselves informed for the latest updates. In the end, I would like to say good luck to all of you for your corporate tax implementation endeavors. Thank you. Over to you, Piergiorgio.
Thanks very much, Rana. Thank you. Much appreciated.
Hello, everybody. Could you hear me well? I think so. So it's really a great pleasure to be at this webinar today. My name is Kanyul Hasanova. I'm from Ukrainian team, International Taxation team. And now we are going to look through some models in which EU companies are used, for example, by Ukrainians, and what impact it will have, these amendments, which and how will it impact and influence our businesses right now. So the next slide, I will. So let's have a look at it's a general model in which EU company is used. So we see that it is established by Ukrainians or other natural persons. And we see this EU company, it's a trading company, because as we all know, it had, previously zero taxation. And right now you also have such a possibility if you meet some requirements, and you heard it from the previous speakers. So we used this EU company as a trading company, and how it worked, for example, for Ukraine. So this EU company purchased for a low price some goods, products from Ukrainian companies or other companies. So, and then sold it with a big margin to other companies, like any other trading companies. And right now, what we have, so these amendments will result in taxation 9% if you remember the cases when it is. So taking into consideration these new amendments, these regulations, you need to be in mind some useful tips, and you have a checklist, list to do in order not to have fines and to be in line with all the regulations. Let's have a look at them. Please revise your contract's purchase cost and selling price, because due to this amendment, in 9% of corporate tax, you should amend your prices, you should review your contracts, and you should also agree it with your contractors, agents. Then you can also rethink the whole structuring, and as you heard, there are some exemptions, and you should meet requirements such as substance, such as a TP compliance, transfer pricing compliance, and please do it in advance. Please find your agents which will prepare your documentation in a proper way, and you attend our webinar, and I think that you already know whom you will address these issues. So, substance overview. My colleague Rakesh also mentioned that this substance requirements have changed, recently, and be aware that we have some substance requirements based on the bank requirements, and their judicial decisions, and maybe from the government. There are also some requirements that you should meet. Please go through the checklist and check that you have everything, sources, relevant sources to provide your activity in EU. Then you should reassess your overall tax burden. We know that when we have a company in EU, we didn't need to pay taxes, corporate tax, and we don't need to have some withholding tax while distributing dividends, for example, to Ukraine or other companies, other parent companies. And now you should reassess your tax burden due to the seat amendments. Okay, and we still know and see and heard that free zones really very attractive to register their companies and to have a business, but in a proper way with all the requirements needed, as we previously mentioned. So I know that today we have participants from all the countries. It's really a great pleasure. And I also know that there are a lot of Ukrainians here. And as I'm a representative of Ukraine, so I would like to also pay your attention to some additional points which could also have an impact on your business. If you are going to restructure your business due to these amendments, you could restructure it. You also, please pay attention to CFC rules. Yes, controlled foreign company rules. In Ukraine, it's strict, but I saw and we preliminarily made such research and saw that these rules a bit the same. Yes, with all the European countries, with some peculiarities, of course, but the same rules. So you are controlled. If you are a controlling person, yes, you own your foreign company, for example, in EU. So you have some additional obligations, such as to notificate, to have a notice, yes, to tax authorities, to let them know that you have registered your company or there were some changes in your structure. You should make a notice to tax authorities, and you should do it in a proper way. Okay. So you are controlling person if you have a 50% or less, but if you have in your ownership structure other Ukrainians, so be aware of it. And it could also apply to other foreigners, not only from Ukraine. I will repeat it. So you should notify the tax authorities, and you should also submit reports. And what is very significant for EU, that in EU, if you meet some requirements, you won't pay taxes. Yes, your taxation will be 0%. But from the CFC point of view, if you have your revenue more than 2 million and you don't have any other exemptions and reliefs, so for example, in Ukraine, you should pay taxes unless you distribute dividends. So it's also interesting. And of course, other last but not least part of this, you should pay taxes in your resident country. Tax rates are different. For example, in Ukraine, it could be up to 10, up to 11% if you distribute dividends. If no, it could be 20%. In different countries, it also can differ. Okay, and for all Ukrainians, also I give such remind them that if you have some violations of this CFC rules, and if you don't notificate in time our tax authorities, so you could suffer from pains. I think that everybody also should be in line with all the regulations, and if you have any changes in your structure, please do it in time. Okay, so it's all from my side. If you have questions, and I saw the chat, there are questions. I think that we will answer them with our colleagues. So you are welcome. Now I pass the floor to Sanya. Yes, Sanya, you are here.
Yes, I am. Thank you, Kanyu. So thank you, everyone, for listening. We see we have a couple of questions, which we were going to address today and now. But during this time, we also have prepared a poll for you attendees. So please just check your interactions tab on your right-hand side and answer the polls while I address the current questions. So first, we have a question. If your company is based in Free Zone and your client is outside UAE, do you still need to pay 9% tax? I think, Rakesh, this might be for you.
Sure. So, as I said, if a free zone entity is dealing with a mainland entities, then any qualifying activity, if they are earning income from a qualifying activities, then they need not pay 9% subject to complying with other conditions like maintaining substance, having a transfer pricing in place, having a financial audit done. But if you're earning other than qualifying income, that is, if you are performing any activities which is excluded, then you will have to pay 9%. So what is qualifying activity? So it has been defined in the recent decision. It is manufacturing and processing. If the free zone entity is engaged in manufacturing and processing of goods or materials, if they are holding shares and other securities, if they are earning income from operation management and ownership management and operation of ships, if the activity is regulated reinsurance, fund and wealth management services, if the free zone entity is providing headquarter and financing services to related parties, financing and leasing of aircraft, logistics services, there's a distribution of goods from in and from a designated zone in a free zone subject to certain conditions. All these are qualifying activities. If you are earning income from these qualifying activities and if you are providing services to someone who is outside the free zone, then you can claim the 0% tax, or else you will have to pay 9% tax.
Perfect. Thank you, Rakesh. And you also addressed Olena's questions, what the definition of qualifying activities are. Now, I have a couple of more questions that were reached out to me directly. So what would be the definition of excluded activities?
So it has been defined in the recent decision. If you are transacting with a natural person, it will be excluded activities. There are some transactions in relation to qualifying activity. Even if you are undertaking it with a natural person, that is fine. But in most of the cases, transacting with a natural person will be an excluded activities. Uh, if you are dealing in a regulated banking, insurance, finance, and leasing activity, that will be a excluded activity. If you're owning an intellectual property and if you are exploiting it, like a free zone entity has a IP in its name, and if it is providing this IP to any other company and earning royalty, that would be an excluded activity. Immovable property other than transaction with a free zone person in relation to a commercial property located in a free zone. So the decision has clearly stated what would be an excluded activity. If your activity falls in any of the list, then you will have to pay 9% tax.
Thank you. Now, Nelson is asking, can a director take salary from two different companies?
So there is no, they can take salaries from two different company. A transfer pricing in the UAE transfer pricing law, the transfer pricing would also apply if you make payment to a connected person. Like a connected person is payment to a connected person is not covered in any of the transfer pricing law in anywhere in the world. It is specifically there in the UAE corporate tax law, considering that there is no individual taxation, there is no tax on the income earned by the individual. So if you are a owner of the company, or you are a director of the company, or an officer of the company, or any relative of any of the above, you will have to comply with the transfer pricing provisions. You can earn salary from two companies, but it has to be, you have to satisfy two conditions. One is the market value criteria, that is whatever you are earning from the company is commensurate with the market value of the services provided. And second, those services are in the course of business or profession. So if you satisfy both the condition, you can earn salary from two different companies.
Thank you, Rakesh. Now we have a question from Anna. According to the ministerial decision number 139, Article 3, in application of paragraph of clause 1 of this article, the activity of distributing goods or materials must be undertaken in or from a designated zone, and the goods or materials entering the state must be imported through the designated zones.
Correct.
Does this mean that if the goods do not physically enter the UAE, either being bought abroad or exported further to other countries without actually entering the UAE, then it will not be qualified income and will be taxed at 9%?
Correct. It has to, the distribution of the goods should be in or from a designated zone. If it is not from a designated zone, then yes, they will have to cough up 9% tax.
Thank you. And now we have time for one last question. Mubashir, shareholder's salary payment by a taxable person to its connect person. As per clause 36 of corporate tax law, a payment or benefit provided by a taxable person to its connected person shall be deductible only if and to the extent the payment or benefit corresponds with market value of the service, benefit, or otherwise provided by the connected person and is incurred wholly and exclusively for the purposes of the taxable person's business. How to assess the market value of the services provided by the shareholders or directors by using transfer pricing methods mentioned in this clause?
So as of now, there's no clarity on this. Okay, how? Because as I said, all over the world there is a transfer pricing provision, but nowhere in the world they have payment to connected person as part of the transfer pricing provision. So either the law will provide clarity or the by using any of the transfer pricing methods which are prescribed by the law, they will have to see whether the payment is at arm's length. The arm's length principle needs to be adhered to. So this, as of now, there is no clarity under the law. We will have to wait for the clarity how this can be determined. This is a new law for the state, and there won't be any comparables.
Super. Thank you. And with this, thank you to all our speakers, Konyul, Rana, Pier Giorgio, Rakesh, Vinit. Thank you to all listeners.
Thank you,
and thank you. We will send out the recordings with the link and also the slides to all of you who have attended today, but also to everyone registered. See you next time.
See you.
Have a lovely afternoon.
Thanks, all of you. Thank you very much.
Bye-bye.